Stock markets have generally been ticking higher this week. The major piece of news was the introduction of the LTRO. This is a scheme that allows banks to lodge collateral with the European Central Bank, in return for which they will provide you with cheap loans for 3 years at a rate of 1%. 523 banks went for this option, and they took over 489 billion euros. And that cash, clearly the market's immediate impression of that is very useful cash, given that in 2012 there is expected to be significant demand for rollover finance, and this removes a potential headache from the market that could have come down the tracks for next year. The worry, of course, if you want to put the glass half full look at this, is of course this may not do anything for the sovereign issues in Europe. There are no demands on the banks to take this cash and go and buy sovereign bonds, which reduces interest rates for the governments. But if that were to happen, then this is the Europe's form of QE. It's what the French minister described as their big bazooka, and it certainly at the moment has been, just on balance, receiving a positive view from markets as we approach the year end. Now, in terms of the year end, that's obviously a good time, first of all, to comment on the year past, and indeed a quick look at the year ahead. I think firstly, in terms of the FTSE 100 index, we look like we're closing the year in the sort of 5,450, 5,500 range, which would represent a loss for the year of about 7% on the FTSE. That's obviously lower than our forecast for the year. Our opening forecast was for about 6,600, and two material events came in during 2011 that materially altered the view. The first was the tsunami in Japan, which did have an effect on the US economy. It proved to be temporary, but nevertheless that caused the wobble in the first sort of or second quarter of this year. But moreover, it was the European bond widening that really put incredible stress onto the system, and the lack of action or lack of resolution to that still remains with us towards the end of 2011 means that we saw slower worldwide growth, particularly in Europe, where we are starting to look forward to 2012 with lower forecasts for economic growth. Taking the UK as an example, I suspect we may have been looking at around 2% as a growth forecast for 2012. Those numbers have been cut back now to about 0.5%. So the outlook for 2012 is for growth, but extremely modest, and the possibility in the first half of 2012 that we will have negative growth of a modest amount, with a second half type recovery. It's with that in mind that we look ahead to 2012, and the good news is that expectations to some extent are much lower and more conservative for 2012 by the market in terms of what impact this will have on the economy and for corporate earnings. We do think the FTSE can make progress next year. We have a target of 6,100, which on this chart takes you back end towards the top end of the range. There are clearly some large events that may or may not take place with regards to Europe. Obviously that forecast is predicated on no disorderly breakup of Europe in there, which remains our sort of central view, but of course things can turn for the worse, so we have to keep a model eye on that. But as I say, 6,100 being our sort of target for 2012. Other features that we're looking at is the oil price. The oil price has, during the course of this year, remained solid in terms of demand, and indeed we're expecting demand to pick up again for 2012 and for the price to increase. We've got to keep quite an eye on the political situation, in particular with Iran, and what impact that may have on the oil price. So we're looking for a higher oil price, as I say, of about 120 there. In terms of attractive economies, we've got to look at the US. The US at the moment is looking like it could grow by 2.5%, maybe even nearer 3% during 2012. The S&P index that we're looking at here is the one of the only major markets that managed to put in almost a positive return for the course of the year. Certainly the Dow Jones slightly in positive territory. That's a material outperformance against Europe and indeed the UK. So it's a sector that we would not want to be short of. In terms of valuations in bubble areas, we've highlighted here German Bunds. There's tremendous amounts of demands on German Bunds and indeed US Treasuries as evidence this week. People looking for safe haven for their money and really not caring about the return that they're expected to make on this. This is the yield at the moment on 10-year money at 1.9%, but some of the shorter dated paper in the US is actually, and Germany is yielding 0% at the moment, so it's really just safe haven money, and we wouldn't be chasing that particular sector of the market. Just two final charts from me. The first is inflation. This is the inflation in the UK. It's remained resolutely high. We had this sort of dip. This was obviously in the recession of 2009, but quickly moved back to 5% plus. The expectation this year is that we're going to see that move back into the sort of 2% range as a lot of energy and food rises start to work their way out of the system for this year. That's going to be required as higher costs of living have really absorbed much of the household discretionary spend during the course of this year. That has put spending under pressure. And the final one in terms of currency for choice is that we're looking at the Singapore dollar, and read a report which talks about whether the Singapore dollar in time could become the new Swiss franc as a safe haven type of currency. A number of things that are influencing this in terms of the strength of its banking sector and the position as a hub for international trade is leading us to look at that as a currency to watch for 2012.